Greetings, everyone. This is Eric, founder and CEO of Cubicle Investing. Visit the website at cubicleinvesting.com. There you can download my free ebook, and also you'll be put into my email distribution where you'll start receiving my weekly newsletter that comes out every Monday at 10 a.m. Eastern Standard Time. So today I want to bring you guys some comments about what took place in the market this past week. Today is February the 19th. And also, I want to talk about the trades that I mentioned last week. Actually, the particular trade that I mentioned on PayPal, not PayPal, Google. Google, yeah. So I mentioned on Google, and also talk about continue to talk about the power of the butterfly spread as it pertains to trading options. All right, so we're back. Let me move myself out of the way here. All right, so here we are looking at pull up my pointer here. So here we are looking at a daily chart of the S&P 500. Okay, there we go. So yeah, here's a daily chart of the S&P 500. And so essentially each one of these candlesticks represents the daily price action of the S&P 500. So for example, if you look at the bottom of the chart here, you can see the date. And so if I hover over this candle here, this is February 8th. This is the price action that took place on that day, the high, the low, where the market opened and where it closed. This here is February 17th, 16th, 15th, 14th, and so on and so forth. And so this past Friday, the market pulled back roughly a little over 31 points. I believe that, it had a lot to do with Joe Biden coming out and basically saying that it's inevitable that Russia is going to invade the Ukraine. As a matter of fact, there's a website that I follow, that I pay attention to quite often, stocklabs.com/news. And it essentially is a ticker tape of news that comes out, every few minutes or so, every few seconds or so. And as you can see here, just recently, about I guess 2 minutes ago, 7 minutes ago, breaking news: all signs suggest Russia plans a full-fledged attack on the Ukraine. I take most news with a grain of salt. Just don't trust most media outlets, but nevertheless, they are saying that that Russia is more likely than not to invade Ukraine. And as a result of that coming out on Friday, again, it spooked the market. You got these large institutions who are heavily reliant on performance, right? And so every quarter they have to report their performance. And so any uncertainty that takes place in the market, these guys are selling first and asking questions later. So they don't have the luxury that we as retail investors have of being, not too concerned about quarter to quarter performance, but we are looking over a long-term horizon. But for us as option sellers, right, we are looking sometimes day to day and oftentimes, week to week, but nevertheless, it's our own money that we are managing. So again, we don't have to report to anyone. So we're not on the hook to meet these performance criteria like these large institutions are. With that being said, I'm still bullish on the market. I still think that we are still in a bullish trend, but of course, no market goes up, in a straight line. You're always going to have pullbacks, and those pullbacks are actually beneficial for us because they allow us to get into positions on great companies. For example, AMD, where we can buy at a discount and then just be patient and allow the fundamentals or the irrationality of the market to basically stabilize and continue on with the bullish trend that we have seen really since March 2020. So the next key level that I'm looking for is this. I'm sorry, I'm on the Nasdaq. This is the Nasdaq chart I'm looking at. I want to look at the S&P 500. So this here is the S&P 500. right? So, yeah, so the next key level I'm looking for is the 4310 level. So I'm looking at the Fibonacci retracement. And this Fib retracement indicator just basically gives me, from my perspective, key levels that I need to look at specifically for the S&P 500. And so you draw this from the lowest point, the lowest price point that the market has experienced over a certain period of time to the next highest price point. So as we can see here, the market tried to eclipse the price point of 45.91 and some change roughly. It failed on 2 occasions, and as you can see here, it has retraced back down. Definitely past the 50% mark, definitely past the 38.2% mark as it pertains to the Fibonacci retracement. And so the next key level, again, that I'm looking for the market to hit, hopefully it doesn't, but if it does, then it will probably go lower. So the next key level is 43.10 and some change. If it hits that level and goes below it, then the next key level I'll be looking at is 42.23, 42.22 roughly. But again, I think that, you know, this pullback is temporary, and I think eventually the market will stabilize and will continue its uptrend again that we have seen since March 2020. So I would say, you know, nothing to be concerned about, particularly if you're a long-term, but as an options trader, you know, we like the volatility, and so the volatility does not scare us at all. As a matter of fact, it actually presents opportunities for us to make money, which I'll be talking about here shortly. So here's a daily chart of the Nasdaq, right? So the Nasdaq, you know, pretty much the same scenario. Nasdaq is tech heavy, much more sensitive to any negative remarks, particularly as it pertains to interest rate hikes by the Federal Reserve. You know, some folks are speculating that the Fed is going to hike interest rates as high as many as 7 times this year. I don't see that happening. Why? Because this here is a midterm election year, right? And so the Federal Reserve is a very political entity, or it has become a political entity over the years. And so I don't think that the Federal Reserve is really interested in really shaking up the market with these multiple interest rate hikes. I do see one coming in March, but I don't see any more than 2 interest rate hikes occurring this year. If there's more than 2, I'd be extremely surprised, because again, this is a midterm election year. So with the Nasdaq being very sensitive to interest rate hikes, if we're only going to look at, you know, from my perspective, we're only going to see 2 this year. Again, I don't think that's going to affect the Nasdaq as much as folks, as much as the market may be anticipating. And so I think that, you know, again, just like I mentioned on the S&P 500, we're going to see, you know, this pullback as a temporary situation, and then eventually, you know, we're going to continue to see the Nasdaq continue in its uptrend. You know, the tech stocks are really the forerunners of the overall market itself. If you know that the overall market consists of 11 sectors, you know, and so the largest sector, or the most influential sector of the market, is the XLK ETF, and that XLK ETF pertains to the technology sector, right? So the technology sector is the sector that really drives the market. Although, because of the issue that's been taking place with Ukraine and Russia, the energy sector, ticker symbol XLE, has really been taken off. And so if we look at that right quick, XLE, which is the ETF for the energy sector, as you can see here, it's been extremely bullish. As a matter of fact, it has outperformed the overall market itself. So any pullback on the XLE ETF or that energy sector, you might want to take a long position, maybe buying a call or buying a leaps option, a long-term equity anticipation security. You know, buying a call that's in the money and just riding the XLE ETF on an uptrend, basically. All right, so I want to review the spread or the trade that I put on last week, that I spoke about in last week's video on the underlying Google. All right, so Google is the underlying that I spoke about in last week's video. The ticker symbol for Google is GOOGL. They also have an additional ticker symbol, GOOG, but I looked at Google, right? I put on a butterfly spread. If you guys recall, if you watched the last video, I put on a butterfly spread, and I actually misspoke in that video. I said that I paid $345 to put on a spread, but I actually paid $375. So the expiration date for that trade was this past Friday, which was February the 18th, right? But I'm going to demonstrate what I did last week, looking at the expiration date of February the 25th. Okay, so just showing you the actual option contracts that I bought and sold. So remember, the butterfly is where you buy. So a long butterfly. So when the butterfly is long, it means that I actually had to pay money out to put the spread on. If the butterfly spread was short, then I took in money, right? I actually made money to put the trade on. In order for me to earn that money, the trade has to go in my favor when the trade expires, or when I close out the trade for less than the money that I received for selling a short butterfly. But nevertheless, this here is a long butterfly, and we know that because just expand this here and clear this. So the platform is going to act kind of weird because the market is closed right now. But nevertheless, we know that it's a long because it's a debit. So when you go to review and send the trade, you're gonna see your order in red, and it's gonna say debit versus credit, right? Let me just do this here. So if you recall, the option contracts that I spoke about in last week's video. So I bought a 2600 put option contract. I sold two, right? You can see here the number 2. I sold two 2550 put options, and then I bought another 2500 put option. What makes it a spread, right? I'm sorry, it makes it, they call it a butterfly spread. And they call it a butterfly spread because in the middle, you are selling two option contracts, as you can see here, right? And on the ends, you are buying one option contract of each, right? So it's like this here is, so this here is the body. Again, I showed this in last week's video. Then these are the wings, right? It could have been called a bird, but they call it a butterfly. Okay. All right. So now just looking at this particular expiration date of February the 25th, my maximum loss would be $545. So that's what I'm actually paying. I'm paying out $545. So that's my maximum loss. I can't lose no more than $545. But I have the potential or the possibility of making $4,455. Right? So the risk to reward ratio is extremely in your favor as an options trader. Okay? So now, in order for me to make money on this trade, the price of Google has to come down in value. How do I know that? Because very conveniently, the platform shows you your profit zone, right? So now I do use Thinkorswim. Thinkorswim is where my bigger account is. But Thinkorswim, I like Tastyworks because it's a much more intuitive platform to use, and it's a better platform to teach from when you're teaching others, options trading, because it's very visual, right? So your profit zone is this green area here. So as long as the price of Google is within that green zone, as we approach the expiration date on February 25th, I make money. Now, if the price of Google should happen to shoot up or increase in value, right? It's anywhere in this red zone, then, I can lose my $545, but I can't lose no more than $545. So what happened was last week after I put this trade on, the price of Google started to increase in value, and so I was losing money. And so what I did was I came in and I sold an additional vertical credit spread. So notice I said sold. So if I'm selling something, I'm taking money in, right? So I decided to take money in by selling a vertical credit spread because I was losing money. So I wanted to mitigate the loss that I had not realized because I hadn't closed out the trade, right? Because this was on Tuesday. This was on Monday or Tuesday when the price of Google actually went up in value, and so I decided to mitigate the potential loss of my $545 by tweaking the trade. So I'm going to show you. So now remember, the strike prices are $2,600. I bought one, I sold two $2,550s, and I bought one $2,500. So I actually took a screen capture of the trade when it was on. Let me just bring it back up here. Give me a second here. Google. Okay, so here's the trade. So as you can see here, I tweaked the trade. So remember, I bought the 2,600, I sold two 2,550s, and I bought a 2,500. Now you can see here, right, that when you buy, you have a positive number. When you sell, you have a negative number. So I tweaked the trade. So I actually bought back the one that I bought at the 2,500 strike price, and I decided to sell. I decided to sell a 2,500 put option, and I bought two 2,450 put options at a lower price point. So remember, originally I bought the 2,600, sold two 2,550s, and I bought 2,500. So now I closed that trade out because, again, the Google was moving in the opposite direction, so I was losing money. So I closed the one that I bought out, and so I sold a vertical credit spread by selling the 2,500 and buying the 2,450. And so what ended up happening was I actually started making money. So as you can see here, this was on Thursday, I believe. I was up $672, right? And I made a mistake. I made a trader error, and I was looking to close out the trade, and I put on a good to cancel. And again, I'm not going to go into exactly what these terms mean because, this is what I teach. But nevertheless, I put on a good to close or good to cancel order, and the trade actually closed out the day prior to the expiration date. And so I ended up actually losing money because the purpose, so I should have allowed the trade to expire by itself on Friday, this past Friday, Feb 18th, and I would have walked away with $672. But I actually closed it out early, and I'll show you I actually lost money on this trade. It's fine. It happens. I made a mistake. And so I actually lost $222 on this particular trade, right? But I caught, I did put on another trade. Well, I put on quite a few trades, but I'm not going to speak about all the trades that I put on. I caught Roku. So Roku had its earnings this past week. And so just pull up the chart on Roku. It's not coming up. Let me just pull it up on the. Give me a second here. I'm just going to pull up a chart on Roku just to show you what happened to Roku last week, and I was able to make $665 on Roku because I caught it. It was actually dropping in value, and so again, another thing about options. Well, really, you can do this with stocks as well, but it's a little bit more riskier with stocks. But with options, you can actually make money when a stock falls as well. So it doesn't matter if the stock, goes up or goes down. You can still make money, right? So as you can see here, this happened on Thursday. Roku was trading for roughly around $159 per share, and it dropped significantly right after its earnings report. So the earnings report came out after the market closed on Thursday, right? And so on Friday, when the market opened, you can see Google was way down and it was already decreasing on Thursday. And so I was able to take advantage of that, and I made how much did I make? Yeah, so we made $665 on Roku, right? So, again, a net positive. Again, I could have walked away with 600 and some odd dollars on the Google trade, but again, I made a mistake and I closed the trade out early. I should have allowed the trade to expire this past Friday, and as a result, I lost money.